Now we got something. Now we got something. What's the matter with this main page? Oh, we got something now. We got something. Hey. You can't stop us. You just can't. There we go. It's like, try to take us down. He said no. All right, we get to go. Hey! We're back. Little gremlin. I don't know what to tell you. These things pop up, but thankfully, they have not popped up as much as they have in the past. If you have been a regular viewer for a few years, used to happen every day, right? So that's not too bad. I'm pretty happy with that. Let's just get right to it. Let's talk about the stock market because all should be good now. I do see it's good. It's perfect. So February, was it supposed to be a rough month? Do you remember this guy right here? We talked about January being really strong, and while that's good for the rest of the year, it's not necessarily good for February. That's exactly what happened. It's kind of cool to see the stats play out like that. And so February is over, by the way, in case you didn't know that already. Tough month, right? But January is really to blame because we know that when January starts off really, really strong, meaning big gains, that February tends to be weaker. And that's exactly what we got here. We're still up 4%, 3.7, right? About 3.7% there year to date. So that's fine there. So not too bad. We got an inflation tick higher throughout the year or throughout the month. And we're like, man, that made the Fed talk tougher. They said, we're going to have to keep rates higher. We're going to have to maybe raise rates even more, maybe that 0.5% rate hike. Payrolls are still strong and still are actually. So economy's doing great there. Spending is still strong. We're still out there spending like crazy. I can't believe it. And most of the companies that reported earnings proved it. So when you see somebody say that I believe this is going to happen, and they back it up with what they can see in the market, what they can see with your spending, we can see how much you guys are spending out there. It gives you that approach that there's, that look of, well, there's really kind of a little sign of a recession here at the moment. Now, that doesn't mean you get the all clear, right? Let me just say it that way. Tonight on Jazz After Dark, I'm actually going to cover why there is 100% chance that we will have a recession. And so I'll share the data with you. I'm not going to I'm not doom and gloom kind of a guy here, but I will give you an exact example there. So join me tonight. It'll be, 7 o'clock. Actually, we'll come back here live. It'll work, I promise. And so we'll take a look at that. Now, as we get to the end of February here, I thought, some broad thoughts. Where do we stand, right? If we're looking around, just things you may have forgotten about, things that are going on out there. The growth of the U.S. economy is still fine, not great, but we have a lot more analysts raising their growth expectations. GDP is the focus than anything else. The economy is still growing. It's just growing slower, and we can verify that through earnings that we've seen through the S&P companies there. The Federal Reserve is likely to hike rates a little bit more, and they're very likely to leave the rates higher for longer. At least that's what they're talking about at the moment. And that's because we had consumer price index, producer price index, the PCE numbers came out and showed that inflation ticks higher, and it's slowing. And we could say it's peaked, but we have not yet rapidly started to fall there. So inflation, we now have the expectation, is likely to slowly fall slower or less. I don't know how to say that. So a little bit less than expected there. The Fed actually expected that. Remember their last Fed meeting, they said, we actually are okay with inflation ticking up before it eventually ticks back down there. And broadly speaking, you have corporate margins tighter. I pretty much mentioned that every time we'd seen something here. Overall margins for companies are getting tighter, but with inflation peaking, we're sort of shaking that off. And so hence we have investors pretty much okay with this pullback here. The S&P, which we're looking at the moment, back to support. It is not handling support very well. I'll give you that. And so really, it's a moment in time for you to look for positions that you want to add to that are pulling back and showing some form of outperformance relative to the S&P, the stock market, the index you're following, and or the sector that you're following those stocks in. I mentioned yesterday that it is an interesting time for options sellers. And actually, in our research site, I did a quick post to kind of show you how to take that from concept to stock pick. And so it's a short post, but if you're a research member, go ahead and check that out there. I gave you a handful of stocks to choose from and showed the actual total return from selling options on those if you choose to participate, and particularly where to look and how to do it, expiration and the strike price and et cetera. If you're not a research member, jazzwealth.com/research, or if you're a client, then it's already in there for you. It is free for you, so be sure to check that out. It is a very unique small window for option sellers, and I know a lot of you guys do that out there, so let's go over here. So enjoy that post. So we know where the S&P stands. If we look at the Dow, we know where it stands, right back on support, and it's also not showing signs of life at support like it probably should be. We have the NASDAQ basically at the same spot. It's not showing good signs of life at support. That's not a good sign. So right now what we have is all the major indices. You need more information. And I mentioned a minute ago, you could be looking for stocks that are pulling back. Go back a few days. We just covered a bunch of them that are doing that. But you could be looking for outperforming stocks that are pulling back. You could be an option seller at this point, covered calls, etc. Or otherwise, you're just kind of waiting. You're waiting for more information. Right here, we actually have a series of videos in our research site as well as for clients that talk about what's happening right there. You just search candlesticks in the research site. It's talking about right here. This last 3 days tells you, I need more information. I'm not confident that we're going to go higher. And although I'm not confident that we're going to go lower, I'm not sure that this is going to hold. What do you do when that happens? You stop. You sit on your hands. You sit back. You wait. You build a watch list. You don't go crazy, right? So that's where we stand there with the markets. Enough rattling about that. Gold getting a little bit of a bounce here. Remember, we talked yesterday of how commodities are a trending asset class, so you want to be careful about that. Maybe a little short-term bounce in there, but also something to probably be careful about. I would say oil looks very much the same. Energy had the worst month, by the way. If you want to look at XL, there we go. If you want to look at XLE, down 7% so far, and really we know that's just mean reversion. We know that it was extended. It was by far the best performing sector last year. We know that oil has yet to rally, and so those prices just need to come down. That's what's happening in the energy space there. If we look at rates, I'm going to use, we'll do bonds here, 30-year. So if we look at rates, not bad. An attempt to rally off of this low. However, they are still at highs, meaning rates are at highs, prices are near lows for the year. So something to consider there. Now, the Fed continues to be obviously the dominant driving force behind what's causing the volatility in rates there. There's now a 26% chance that they're going to raise rates by 0.5%. If you go back a month, that was a 0% chance that they were going to raise rates by 0.5%. So people are watching that on a daily basis to see if we're really getting used to the idea of a 0.5-point rate hike there. Remember, from history, and this is not my opinion, but when the Fed, or I should say, the more and longer they have to remain tight, quantitative tightening or being tight with overall interest rates there, the longer that they remain tight, the harder the market eventually takes a hit. So, right now it's fine. It's fine that they want to raise rates. We're on a consistent path, although a very sharp path. But the longer we have to hold rates up there and wait for inflation to come down, well, it's just going to come down a lot faster. And it's going to drag the markets down with it. Okay. We're going to go take a look at some sectors here. And I'm going to do this on one simple chart. Let's take a look. Don't let it scare you. It's all good. What we did is we took the every sector in the S&P and then the S&P right here smack in the middle so you could compare. We're looking at the year-to-date returns, that's in black, and then in blue, the total yield or what's the current rate, dividend rate, right? So over here, consumer discretionary with the best returns and the lowest total yield. And that's just because of how January started. We all wanted risk to start the year. Consumer discretionary, tech, we want to be a part of that. Communication services, which is a lot of tech. And so those are by far your best performers. Still, you're getting the lowest yield. Now remember, and this is the best way to see this here, all the way to the right, your recession type sectors, utilities, healthcare, consumer staples, right? All the way to the right. You got energy in there, but we now know what's causing that. These are your worst performers. Utilities 6, healthcare 6, right? Consumer staples down 3. We'll skip energy for a second. But that's where the yield is at. And so now think about what you do there. If you're someone who says, I want to focus on dividends, I want to be a little bit slower, I want less volatility in my account, I do agree that we're going to go into a recession. Now look what's happened. You have avoided a 6% drop that's all but wiped away your year's worth of yield. But you have a 6% drop, 3.3% yield at the moment, which of course changes. But now you might have a recipe for a discounted, low volatility, recession safe, that's a tough word to use, recession safe type sector that pays you over 3%. If you're someone that says, I'm not going to bonds, I want nothing to do with it, I just want to be in the market, I want to be able to shift and move around. So really, really cool there, something to take a look at. And tomorrow what we're going to do is we're going to go through each sector and show the most overbought, oversold stocks. So we'll actually look at utilities and say, if you like the most discounted, sort of weakest stocks in the short term, here they are. I can't tell you, to buy them, but at least you'll know which ones they are. There we go. Hey, we got some great classes. Our wine and wealth classes are been pretty good lately. We're trying some different things. We've done covered calls. We're going to expand on that. We've done return on capital. We're going to expand on that. How to get the highest return on capital of every dollar that you have. I'm not saying you invested in the market. Whatever you're using it for, how to get that highest return on your capital. We talked about joint accounts and individual accounts and the sort of trickery that rich people play there. And this week, this Thursday, Eric is going to join you, and we're going to be talking to new clients of Jazz Wealth, going over everything that has to do with what you get here at Jazz and where to find it, so you know what to expect, and you don't feel like you're getting left out in the dust. We don't like that. We're going to pull everybody along, make sure you get your dough straight. Okay, so you got Zoom. Actually, it was higher after earnings. This is a little bit of help for Kathy Woods after hours, because she's betting pretty big on Zoom, and she's doubling down on her comments there. But ultimately, it opened up and really didn't do a whole lot today. I thought it was over 79 after hours yesterday. Not too bad. It was a 2% revenue beat, 53% beat on earnings, but that's because they had a lower, what was in the terminology there? They had a lower churn on their subscriptions, meaning people just continued to pay. They've just, chosen that to be their software for communications. And so there you go. Occidental Petroleum. So they reported earnings that were better than expected, and they said, you know what? Forget about this buyback nonsense. We're going to buy back $3 billion worth of stock, and we're going to raise our dividend. We're doubling down on the idea of giving money back to shareholders. And they weren't the only ones today, by the way. Chevron is the other one. There's a lot of energy stocks because they're kind of flush with money right now. They said we're going to do buybacks in the range of $10 to $20 billion a year. So they're not even putting a cap on the amount or a cap on the time. They're putting a cap on the amount and saying, hey, we're just going to do it. And we're going to spend money on these buybacks regardless of what Washington says. Smuckers wasn't really a mover. We probably don't need to cover it. They reported earnings there, just fine. IGT, yeah, some of you familiar with them. We actually have some clients that work for them out west. IGT reports earnings better than expected. Why is that? Anybody guess? Well, it would seem that people are back out to the casinos. Am I right? And then Target's in the news there. Target had earnings better than expected. They did their guidance. You guys know what this means when you say their guidance was at the low end? You ever see that on TV or you read about it or something? What they're saying is so Wall Street basically sets a range that they expect, and it's based on their analysis and their supposed, expertise. It's fine. And so when Target gives guidance as to what to expect going forward, we're looking at that range that Wall Street set. And Target basically said our guidance is going to be closer to the bottom of what you guys expected. So it's a less rosy picture there. But otherwise, earnings beat by 26% more than expected there. It's just that guidance was the focus, and I think that took some of the steam out of things today. But hey, it's lucky enough that they're even giving guidance. So we should be sort of thankful. Before we move on here, tomorrow we've got earnings. Remember, it's kind of retail and consumer discretionary from here. So we have Splunk, Jazz Pharmaceuticals is in there. Stole my ticker. Salesforce, Wendy's, Lowe's, Kohl's. You're seeing all the Abercrombie and Fitch, Dollar Tree. So we got a lot of those people reporting. Other than that, a little bit of changes in the S&P 400, S&P 600, not too much going on there. I'll take your questions. Sorry for the delay and slight hiccup today, but we think we figured something out that actually we did not know. So we'll leave things as they are. If you have any questions, feel free to hit me with them. I'm going to try this and see if this works. Ooh, this is working much better. This is working much better. All right, AJ says, oh, it's bigger too. With all the buyback and dividend news by energy companies, the sector is still not doing great. There seems to be a divergence. What do you think that is? The sector is still not doing great. That's just purely, you can call it mean reversion. You can call it a reduction in the spread. I've shared that before, where we showed that divergence between energy as the value of the energy sector versus the price of oil and energy at the moment. They don't normally spread out like that. Oil pulling back while energy's still going up, that can't happen forever. So that's like a clear way of showing the value of my company is going up, but the product that I'm selling is not worth as much. How can that be for too long? That's the simple way of saying that. Oh, you like the options stuff? I know there's a lot of you out there that do that. I like talking about it too. So it's not really our day-to-day kind of wheelhouse, but every now and then I like to talk about it because it lets me have a little fun. Are you recommending selling calls on all of those? I'm not making a recommendation. I'm saying if you did those to each one of those, this is what your yield would be. And if you chose to do all of them together, your 30-day total return is 2.2% if you want to dig a little deeper in that. You want to do CDs or bonds at current rates? Ally has no penalty CDs at 4%. So for most of you, I would suggest CDs only because remember, bond prices move. And not a lot of people will just throw money there and let it sit. What happens if the market really pulls back and you want to invest? You're very likely to want to invest that money or some of it. So I would just suggest CDs, especially since most of them are waiving any of the penalties for cashing out a little early. Yeah. What are some of the S&P changes? I'm not sure. Did I say something? Specific combo or different ones? What are you asking? Specific well, so the main point of that was if you own the stock and you're trying to sell calls against them, here's the ones you want to do them to. Other than that, you might have a preference. Like if you look at some of the names on the top of the list, you go, that's kind of not doing a whole lot. I don't think I want to mess around with that. Or it could be in a sector you don't like. What do you think about starting a position in AbbVie here? Seems to be ahead of the XLV early in this rally. I agree. There's a couple of them. So AbbVie is one of them. Where was the United Healthcare since has fallen apart? Okay, so yeah, I don't disagree with that. Goro stock. What do you mean? You guys got some weird questions today. Marcus, whatever happened, all that talk about Morgan. I can talk about Morgan all you want. What do you want to talk about? What do you think the student loan think? My goodness. Like, am I having a stroke here or something? I'm not. I saw that. I don't follow it. It's none of my real business. It's going to be what it's going to be. I don't have any input into it. They don't take my opinion. I disagree with it, but there's nothing I can do about it. So it doesn't really matter what I think because nobody's asking. Nobody that's making decisions is asking. You think a stock market recovery later half of the year? Yeah, remember the data that we shared there. For the first half of the year after a strong January, if you don't see a whole lot, that would actually be normal. Yep. Volatility is high. Is it also selling puts? You can. I didn't give those numbers, but you can. That's personally what I would do. Just I enjoy that a little bit better. Student loans should be paid by students, not by the government. Oh, Kirk, yes, you're paying. I love the one. I love the Instagram or whatever the video is where the guy goes around and asks people to sign the petition. Will you sign here to get student loan or to have college for free and have student loans paid off? And the people are like, oh, sure, sure, sure. And they start writing and he goes, and then also to the right, what percentage of your income you want to give towards doing that? And then they all stop and say, wait, what? No, I'm not doing that. I love that. Any suggestion on Goro stock for a swing trade? No, I wouldn't have one. I don't look at the penny stocks, and I don't like that it's just falling apart like that. So, no. No, no, no. What do you think of the 5% tax? I think it's going to be 4. Now, actually, I don't know. Is it 4 in addition to the one that already exists? That part I don't know. But, I think it's a joke. We talked about it when they put the 1% into effect, and now this talk of the 4%. It's not a rule yet. It's just they're just talking about it. But that's pretty silly. That is maybe just someone or the president in general just probably getting quick or poor advice. Yep. No, it's a fun video, Kirk, and I think the guy just does that all the time. He just walks around and does that to kind of make his point, but it is funny. Free college? Yeah, sure. What percentage of your income do you want to give? No, I can't afford that. I don't want to do that. Everybody's turned off. We talked about Buffett getting a little upset yesterday. Yep. Yeah, we're going back to COVID here for a little bit. I know somebody that just got it, actually had to call off work. One of my wife's friends. Or at least got whatever version of it is. You like your Plug Power earnings? Nice. March performance, I'll actually be posting that in our Notes from Jazz this weekend. So we'll go through kind of the seasonal monthly performance. March is technically or historically more of an active month there. You think SQM will benefit from the lithium demand? Yes. Yep. That was my poor second choice for stock of the year last year. I should have picked that one ahead of Roku, but chose Roku for the name brand. How can you use your IRA to fund a new house construction project? Yeah, you remember an IRA is yours to do what you want with. I'm assuming you're saying a traditional IRA. You don't need anybody's permission to take that money out. Now, the IRS may have a concern. If you take out more than $10,000, they may say, yay, you're going to have to pay us some tax. And if you're under 59, they may want you to pay a penalty for that extra amount. But no one can tell you no. They're taking money out. Do customers of Jazz get to see internal Jazz funds returns? Yeah, of course. Yeah. And the positions and the weighting and all that stuff. Yeah, we legally have to show you that anyways. And I like showing you that because you wouldn't, maybe you would, but you wouldn't think it would generate so many questions, but I love when people have those specific questions about the funds. Shows you're paying attention. Yeah. Hi, Dustin. Do you fly the plane? Yes. What do you think of NVIDIA raising money? I think they're raising $10 billion. If they want to toss us, 500,000 or something, we'll get a few more developers. I'm not asking for much, for goodness sakes. Good for them, though. Secret Stealth IRA and wife's nickname for the kids needed. What's the best platform? Secret Stealth IRA in the wife's name for the kids. Any platform is fine for that. And we'll keep the secret between us. Between the big run-up at one point, SQM not far from where it was, and I do see big upside from here. So I haven't looked at it in a while. I just had it typed in a second. I don't think you can assume. This is the trouble with this thing. There you go. I don't think anyone can assume that it rockets higher from here. What would be the reason? I can't even think of a reason. So I would go no on that one. I would not fear missing out on something big. Nate says, are shareholder activists a normal thing? Yeah. First time seeing this regarding news of Salesforce. They have, oh yeah. It was really big for ExxonMobil. That was probably the the biggest media covered one that I'd saw in a while. Shareholder activist, very much normal. That's a strategy in itself. That's a business in itself. Dan Loeb is one that gets a lot of attention when he does that sort of thing. Of course, Carl Icahn can be, his group. Yeah. What kind of plane do you fly? I'll fly any that anyone will let me fly, safely, if I don't know how to fly it. But just the little guys. I'm not like, don't put me in the like Instagram private, jet kind of thing. I don't do that. One day. I want to fly it though. I want to be like John Travolta. I'll fly the plane. I don't really care about the seats in the back. Do you have a forecast for the summer's weather on the... That shows that I don't read the questions ahead of time. I'll say hot and humid. All right, a couple more and I'll run on out of here. Hi, Dust. Thanks for putting up with us, by the way. What do you think about Google or Alphabet back near its lows after the mistake of AI? I don't know that people are over that yet. You can see it, right? You can see the money not willing to dive back in. And that's, are they going the way of Intel where people perceive them to be considerably behind? And publicly they make the mistakes to show that they are a little behind. I don't know that I'm racing back there. Or in a very, very big hurry to add more to a position if you have one. I didn't have one for 2023, J-Dub. What if we're all robots and Dustin is ChatGPT? I feel like that some days because I remember things that I probably shouldn't remember. Yeah. Any ratings? Oh, look at you go. Working on instrument. And I would happily fly a P-51. Yeah. I would go nuts on that thing too. I would not hold back. Presuming that somebody's there to recover in the event of a problem. Kirk says you want 3 more rate hikes. I'll go 2. Not by counting 25 basis points of pop. I'll go 2 more rate hikes this year. What the amount is, I don't know. Yeah. That's a weird question. Where do 1-month T-bills sit on the good idea list? I don't know. You know what I mean? Who are we talking about? What is the need for one to participate? Are you 30 years old and that's a bad idea? Are you 50 years old? It's probably still a bad idea. Oh, Keith has got me. Keith's your resident pilot there, man. Keith will fly us where we need to go. I don't want to sit in the back though, Keith. You let these other people sit in the back. I'm sitting up front with you. I love it. All right, we're getting a little off topic. We'll save that for the Jazz After Dark stuff when y'all are ready to hang out. I'll see you tonight, by the way. We're going to cover why we have 100% chance of a recession. Like it or not. Enjoy the rest of your day. I will see you later, and thanks for putting up with us here for a little hiccup. We'll be back tomorrow.